Hugh, it's great to see you. And I've seen a lot of takes about hard, soft, no landings and all that. This is the first time I've seen someone say, give me the hard landing, bring it on.
Yeah, really simple, Kelly. I've looked at all of the so-called cycles since 1890. In each case, you get, of course, a bear market that's accompanied by, really followed by, an economic recession. And in 23 of the 25 bear markets that have been accompanied by recession since 1890, the bear market has ended and the bull market has begun in or during the recession. Not before, not after, but during the recession. And of course, the reason for that is pretty simple and pretty straightforward. And that is, when you get the hard landing, when you get economic numbers that are not very good, that's when you get a change in public policy. That's when the Federal Reserve will start to lean towards less restraint. We'll start to maybe not just pause, but maybe lower interest rates. And that's when prospects for the economy and earnings, importantly, start to get better. And that's when stocks turn. So bring on the hard landing. I don't think it's going to be a severe hard landing. Let's have it. Let's get it over with, because it's during that hard landing that you're going to get a turn for the better in both indicators that lead the economy as well as stock prices.
Right. So I guess the other camp, Hugh, would say, no, it's not that we want to delay the hard landing. We want to avoid it altogether. And we think we can avoid it. And it's going to be somehow, I don't know what the rationale is as to how that can happen. But do you think that there's hope that the hard landing can be avoided altogether?
Of course, there's always hope that we're going to be wrong, that forecasters are going to be wrong. They've been wrong many times in the past. We could avoid a hard landing. We could have a soft landing. But, Kelly, when you take a look at the numbers, look at the index of leading economic indicators declining for 10 successive months. It's done that 10 times since 1960, and on 8 occasions we've had the recession. Take a look at the yield curve. I know a lot of people want to criticize the yield curve. Mm-hmm. It has a really good record of forecasting recession. So yes, you're right. We could avoid it. We might not have it. I don't think that's going to be the case. The numbers right now tell me we're headed towards a hard landing, although it's not likely to be very severe based on a lot of factors.
I mean, what's the playbook, Hugh, as people then are weighing, and of course, listen, at some point, let's just fast forward and I guess get it over with. Yeah. But what's the playbook for an outlook that says we are going to have a recession, we are going to have a worsening bear market? How should people be positioned until that happens, right? Because if everybody wants the recovery, but you have to wait for the bear market to get the recovery, then what do you do in the meantime?
Yeah, you take your clue, quite frankly, Kelly, where you should always take your clue, and that's from the financial markets themselves. We're getting some fairly interesting numbers coming out of the financial markets, between the beginning of 2022 and basically October 13th, you saw the markets perform as bear markets perform. But since then, you've had some fairly positive, interesting performance. You've seen bull market sectors like materials, industrials, and technology post good relative performance. You've seen small capitalization stocks outperform large capitalization stocks. No, the market's performances have changed.